Hi, I'm Mike Reynolds, the senior reporter covering the media industry for S&P Global Market Intelligence, Tech, Media, and Telecom News Team. Welcome to Media Talk, a podcast hosted by S&P Global, wherein our news and research staff explore issues in the ever-evolving media landscape. Today, we're joined by my colleague, Yuri Struda at Market Intelligence, and we're going to be talking about generative AI funding and data centers. Yuri, how are things in London today?
Hey, Mike, thanks for having me. London is sunny and there are signs of spring.
Very good. Yuri, thanks for joining us again on Media Talk. We do appreciate it. As we discuss GenAI and data centers, it should be noted that Yuri played integral roles in a pair of recent webinars on the subjects: GenAI VC funding, a 2026 outlook, and data center deal making. Can the record-breaking momentum continue in 26? Let's start with the GenAI VC funding forum. That was more recent. Can you tell us about the webinar?
Sure, Mike. As you mentioned, we did two webinars back to back. Essentially, both were delving deeper into some of the research we've done around data centers, deal making, and GenAI funding. The GenAI funding webinar is a feature that we're producing quarterly, and this one was the third GenAI funding webinar. This time around, we had Ash Patel from Houlihan Lokey, the investment bank, and our own Seth Schaefer from Kagan as panelists. Ash offered insights into the deal making in GenAI and the broader technology space. Seth spoke about some of the surveys he did on consumer adoption of GenAI technologies.
Cool. All right. Let's go to the top line here with generative AI funding. Funding is going through the roof, about 100 billion. Is that right?
Yeah, that's right, Mike. And depending on how you take it, but if you focus just on GenAI application, then that's about right, about 100 billion. If you spread it out to the layer that is AI infrastructure and general AI applications or AI applications that don't generate content, then the funding probably rises to about 130, 140 billion last year. And yeah, it has been a strong year in 2025. Of course, GenAI has sucked up a good chunk of VC capital. It's not only from VCs, but also from strategics, the hyperscalers, the Middle Eastern money, private equity money, lots of money from different players.
And there's a couple of really big deals in the first quarter. Is that right?
Yeah. If we are looking at the first quarter, basically, of this year, which hasn't ended, just the first 2 months, we've already had this massive OpenAI funding round at 120 billion.
Really? Okay.
And with this funding round alone, we've already beaten the record for the entire of last year. And on top of the OpenAI funding, earlier you had the Anthropic raised 30 billion and X.AI raised another 20 billion. So just this year alone, we are at about 155 billion in capital raising by GenAI companies, which you compare with 100 billion last year. Third, the first quarter is not even ended yet, but to be fair, I think this year, this quarter is probably going to be a massive quarter. And then during the year, you probably don't have a lot of companies that will need to raise such big amounts of money so as to skew the numbers even higher.
I got you.
So X.AI will not raise anymore because they merged with SpaceX, and OpenAI probably won't raise too, because I'd be surprised if they need more money this year, given the $120 billion raise. And the only one that could raise is probably Anthropic, that could raise another possibly bigger round. But what it will also be interesting to see is not just these 3 or 4 players that can outpace everyone in terms of money raised, but also what's happening in the money raising at the application layer in the funding rounds of $50 million, $100 million.
Okay.
And we also want to see, for example, what's happening at the infrastructure level. Last year was a very strong year. The growth was not as high as the application layer of foundation model, but there still was a lot of growth. So basically our focus is going to be the GenAI application layer and GenAI infrastructure layer, excluding the foundation model providers. And I think we're probably going to see a lot of funding in that area too, because with the large foundation model players a lot of the smaller VCs or traditional VC companies, they can't be competitive because they might have at 120 billion and their fund may be just 1 billion. And this is already a very big fund in VC and they can't compete there. So they have to move up the value chain into the application layer and find opportunities there that are not as capital intensive as the foundation model providers. They need to move into fund companies that are targeting maybe smaller markets with niche products. And I think this is the space that we're going to watch this year.
All right. As you said, still about a month to go in the first quarter. So let's see how things finally weigh out. A lot of enterprise investment here, especially in Europe. I think there a lot of consumer adoption of AI tools. As you mentioned, Seth Schaefer, principal analyst at Kagan, does a lot of work on streaming, is involved with some of our consumer insight surveys. He says that, again, there's just a lot of enterprise adoption.
Yes, Kagan and Seth Schaefer, they are looking at the consumer adoption trends of GenAI tools. And then we have the folk at 451 Research, now part of S&P Global Energy Horizons. They are looking at adoption trends within the enterprises. I would say it's worth noting that traditionally, consumer adoption of new technologies happens much faster than enterprise adoption. And I think similar trends we're seeing with this technological shift. So we have strong adoption growth at the consumer level. With enterprises, it's a bit more complicated. Enterprises typically start experimenting with new technologies and they launch pilots to see if GenAI can generate savings. But 451 survey suggests that failure at the pilot stage is still very high.
All right. I think what I took away from listening and reading a summation of the webinar, Chat GPT is the leader here in terms of consumer adoption and the like.
Yes, in consumer, ChatGPT remains the undisputable leader. They were the first one that launched the product. They launched this sort of AI revolution or AI craze, so to speak. And that's the survey results are not surprising. We have recently been witnessing this sort of specializations of foundation models. So OpenAI is winning in the consumer, Anthropic is winning in the enterprise or sort of specializes in the enterprise. And then you have Google's Gemini coming strongly behind in the consumer. And you have X.AI that maybe is better at financial news. You have European Mistral AI that is good with European languages and is used a lot here in Europe. The undisputable sort of leaders now are obviously OpenAI and Anthropic. And I think you saw that Anthropic poking fun at OpenAI with that ad during the Super Bowl.
Right.
Where it said Anthropic will never have ads, unlike OpenAI, which is actually looking to roll out ads. And of course, you typically don't need ads if you sell into the enterprise, but in the consumer space, ads are typically needed to maximize revenues.
So we've got a lot of arrows pointing up. Maybe this one not so much in the software as a service sector. There's been a sell-off among these stocks and via AI's disruption. I guess one of the questions here is, just does AI serve customers better?
Yeah, you noticed, right? It has been a bloodbath for the public SaaS sector. Investors are asking whether SaaS will be losing their pricing power. Ash Patel from Houlihan Lokey said during the webinar that the markets are asking themselves whether AI native businesses have a fundamentally better way of serving customers at a low marginal cost, which is bad news for SaaS. So the question is legitimate, but whether the sell-off has gone too far, I think, is a question that is yet to be answered.
And this has been going on for a while now with them, right? This isn't just a recent occurrence.
Yeah, I think we've done some research into the SaaS space. And I also said during the webinar that SaaS has for long been this spoiled child of investors among other sectors. So as a SaaS, for example, you could run huge losses. Most of the losses are stemmed from share-based compensation, which is very high. And you typically still get a very high multiple, a very good valuation, as long as growth was there. So what you needed to show is just growth, profits can wait. You can dole out shares to employees. And this has been going on for a very long time. And I think now investors are starting to question this premise and increasingly want these companies to get in better shape financially. They will need to reduce share-based compensation and show investors that they can be profitable, and also convince them that they're not going to get disrupted by AI.
All right. Let's talk a bit about code generation and its attachment to GenAI. This is an important use case, right, Yuri?
Yeah, so coding use case and SaaS selling off, they basically go hand in hand, because for now, I think coding is by far the best use case for AI right now. And we are also noticed some of the biggest inflows of VC capital in the application layer. They go to coding, not to image generation, not to video generation, not to synthetic data generation. A lot of the capital at the application layer is going to coding indeed. You have a lot of startups that cropped up, and these startups, they're using models like that, like Cloud Opus of Anthropic. And this model is very good at coding. And you are also seeing a lot of foundation model providers, because coding is very good and it's an important use case. You see a lot of the large players like OpenAI and Anthropic, they themselves are moving into this space. Yeah.
Okay. That's the GenAI look. Now let's turn our attention to the data center webinar. That one was, again, as mentioned earlier, data center deal making. Can the record-breaking momentum continue in 26? Also held recently. Yuri, what was going on with that one?
Yeah, so this webinar, we also presented our latest research into the investment and M&A into data centers. And the theme is also connected with the general GenAI demand theme. And we had Kelly Morgan at the webinar. Kelly is a research director for data centers at 451 Research. And then Richard Ludwig, director for digital infrastructure deals at investment bank Alantra. And our colleague Sarah James moderated the webinar.
Data center deal making reached record levels last year, Yuri. Is that correct?
Yeah, so that is correct. So we reached about 70 billion in deal value in 2025. This is the highest ever. And I think a lot of the deal making was driven by one deal, the acquisition of Align data centers for 40 billion by this fund set up by a lot of companies like Microsoft, Nvidia, some private equity money, and some Middle East money. And I would say we've also had, in addition to M&A, there has been a lot of investments in data center companies, as well as asset sales.
All right. Hyperscaling, a lot of demand there. And forgive me, hyperscaling is what for the lay listeners among us?
Yeah, so let me provide some background here. In data centers, a lot of the consolidation already occurred in the period before the pandemic, say between 2015, 2010, 2020, 2021. And you had increased deal making during the pandemic. And this is how some of the largest companies in the US that we have now, like Vantage Data Centers and Equinix, they already consolidated smaller regional players. And now you don't have much of consolidation taking place because consolidation already occurred. But what you have is a lot of demand from the hyperscalers that generates demand for deal making. So the hyperscalers are, to answer your question, are essentially the largest cloud infrastructure providers in the world, which we all know: Amazon, Microsoft, Alphabet, Google. They provide this cloud infrastructure. And with AI demand growing, these companies are engaged in a race for AI supremacy. They're spending massive amounts of capex to build their infrastructure. And this means data centers, chips, energy, and all this translates into demand for data center assets.
Thanks for that. Appreciate it. It brings it a little clearer. Anyway, so all that being said, why was 2025, why did it emerge as such a big year?
Yeah, I think there is a lot of demand from, as I said, from the hyperscaler.
Right.
You don't have a lot of deals. By the number of deals, the year isn't actually that high, but you have a lot of spending, and the data center assets have become more expensive than in recent years. And as a result, you have this fewer deals, but the numbers are inflated because the data center assets are more expensive.
Makes sense. Makes sense. One thing here, maybe lurking behind the scenes, power constraints. You have to have consistent power, electricity to make the data centers work.
That's right, yeah. And we have had over the past few years with the development of GenAI and a lot of constraints development because demand is growing so high. Demand is growing at a very fast clip. And as a result, the suppliers sometimes can't keep up with the demand. And you have these bottlenecks. And now it appears, for example, that memory is a big constraint, and you are seeing that the main memory makers, which are three of them, they don't have capacity for non-AI products like gaming. So they can't build memory for other products than AI because demand from AI, and they need time probably to build more capacity. Increasingly, there seems to be that energy will probably be a bigger factor in bottlenecking AI because it takes a lot of time to bring energy online. And we've seen a lot of the hyperscalers getting in bed, so to speak, with players that they usually won't deal in normal circumstances, like crypto players and other players that basically have access to energy. And data centers can get access to energy via the grid, and they are resorting to behind the meter solutions, which are mostly powered by gas. But there too is just three firms that make these gas turbines, and their order book is full to 2030. And they're also raising prices. And I think Kelly Morgan from 451 said that during the webinar that 2026 could actually be the year where a data center project fails due to lack of energy supply. We'll be watching that for sure.
Yeah, you've got to have the power to make your projects go.
Exactly, yes, yes.
What's the situation now in terms of valuations within this sector, and how are they changing?
So I think some of the valuations in private deals have been really high. So EV to EBITDA running into the 80s, in some of the deals 50s. But it's worth noting that a lot of the valuation here depends not only on the revenue, but also the power secured and land available for expansion. So if you are a data center with lots of capacity to develop, then you could get a high valuation on traditional metrics like EV to EBITDA. But if you look at publicly listed data center companies like Digital Realty and Equinix, they're not trading at crazy high multiples. They are still around like 20x to 25x earnings.
Okay. If we take a look at a global view here, where are some of the key markets now for data centers?
Yeah, so I think if you look at a good amount of deals in data centers are happening in the Asia Pacific region. And I think Kelly Morgan said that in Europe, you would also have the Nordics as a key growth area.
Okay.
Mainly because lower power prices. In Asia, you have Japan and Malaysia's Johor region near Singapore. These are emerging as important hubs. And if you're looking at the deals, a lot of, as I previously said, a lot of consolidation in the US has already taken place, and some financial sponsors that want to get a piece of the actions or strategics that want to expand, they are looking further out of the US and they are targeting these markets, Asia Pacific and to a lesser extent Europe, to buy new data center assets.
Let's finish up here in a similar way we did with GenAI. We're 2 months into the year, basically. What's your outlook for the balance of this year and maybe as we move into 2027?
I think we are going to have continued the robust demand for data center assets, but it's worth noting there is a shortage of targets. And a lot of the financial players, they're keeping on to their assets for a decade or so. And investors will probably have to pay up.
So you're saying that they're holding on to these investments for a while?
Yes, exactly. Yes. A lot of the financial players that bought these assets a few years ago, they usually don't sell them on in 3 or 5 years. They're keeping on to these assets for a longer period of time. So you have this shortage of assets to buy. And as a result, deal activity can suffer because you don't have these assets. Or if you really want this asset badly, then you will probably have to pay up, maybe convince a financial sponsor or some other player or owner to sell the asset now at a higher price of waiting maybe a few years before monetizing it.
Some interesting dynamics and play that way. All right. That concludes this episode of Media Talk. Many thanks to Yuri for sharing his acumen about generative AI funding and data centers and some of the highlights from the recent webinars. Yuri, we appreciate it very much.
Thanks, Mike. It's been a pleasure.
You can check out Yuri's stories by going to Cap IQ Pro. And if you want to gain access to the replays to the webinar, you can go to the appropriate tag on S&P Global Market Intelligence. And this is Mike Reynolds. We appreciate all of you for listening. We'll catch up soon in the next installment of Media Talk.